Let's do this. There's such interest here, the bull versus bear case, and I guess we know Doug Cass, the trader, going along today off of a really committed short of the last number of weeks. With a longer view and an intelligent view is Jay Pelosky. He's with TPW Advisory and far more with decades of experience. Jay, I want you to get us out 9% on the Dow Jones Industrial Average. We talked to Laidler, the bull, earlier, Ben Laidler, ex-HSBC. We talked to Pelosky today, the bull, and somehow we're magically going to get out to Dow 38,000. How do we do it?
Wow. Okay, Tom, thanks for that lead-in. I'm not sure about Dow 38,000. I'm not really super bullish on the U.S. equity market. We're actually underweight the U.S. relative to the rest of the world. But I do think, look, it's been a very challenging environment, very choppy. You know, pick your reason to be bearish. Hard to be bullish when there's so many kind of missiles coming out of nowhere, power shortages, Evergrande, et cetera, edicts out of China, you name it, U.S. political uncertainty. But I think the key point is in that environment to keep your eye on the big picture. And the big picture for me is really one of several components. One, most importantly, Delta is fading as a key issue for financial markets. Two, Asia is reopening. Japan just announced they're going to end their lockdown. So Asia reopening is a real critical issue here. And three, growth is bottoming. Just as everyone's talking about all these issues, supply chain, all these worries, the Citi Economic Surprise Index across the globe, in the U.S., in Asia, and in Europe, all three of them are bottoming and turning up. So to me, I think we're going to exit this year and go into 2022 with a synchronized global expansion.
Interesting.
That's the first time we've had that since COVID began, and that's going to cure a lot of these ills. And we will have had plenty of opportunities to sell, and therefore the market will move higher because they're going to be, in a very simple explanation, more buyers and sellers as we look into that much more favorable 2022.
Thanks for the last bit, Jay. As always.
There you go.
Thank you, sir.
That's easy.
I know. The synchronized global growth
so
then
early in the morning.
that we didn't get this year. Jay, you think we get it next year? I just wonder how the dollar fits into that, because right now on the screens, dollar stronger.
Yeah, no, I think that's right, John. And look, Delta was provided a lull that I at least wasn't expecting for it to be as significant. So what that did, this Q2, Q3 lull, which is now over, even though everyone's still focused on it, markets focus forward, that lull pushes inventory restocking, et cetera, into 2022 and reaffirms the growth profile. The dollar, look, that's tricky. One could argue that it's broken out. My view is that right now the rest of the world still hasn't confirmed that synchronized expansion. Once that expansion is confirmed, then I think dollar weakness follows. The dollar has had multiple opportunities to break higher. Now it looks like it is technically breaking out. Does it sustain that breakout? I tend to doubt it. That's not the position that I have at the moment.
Jay, it does underscore that there is a different nature to this reflation trade. And I know that you're leaning into cyclicals, but the nature of which cyclicals will outperform at a time of higher oil prices and supply chain disruptions that keep crimping some of those margins in specific sectors. I'm thinking industrials and materials in particular. How much is that changing what you want to own?
Yeah, no, I think that's, again, a right on the point question, because we are bullish, especially in the U.S., cyclicals and value and small cap. That's our positioning in the U.S. We're in the early phases of a transition, multiple transitions as I see it, all very important. The first is from a liquidity-driven market to an earnings-driven market. The second is from a growth-driven market to a value-driven market. And the third, which ties together with this, is the fact that we're ending a 40-year bull market in bonds as we break higher in interest rates, which I think we'll do over the next 6 to 12 months. We get to above 2% on the 10-year. That's going to break a 40-year trend line. So I think what we've seen this week with the things that we're talking about in terms of bond action, to me, that's just a precursor of what's going to come. And so it does come into your cyclical to get to your answer your question, Lisa. Sorry for the roundabout way. But we're focused on financials because of that rate outlook that I just expressed. We're focused on energy. I think we're going to be able to make energy something I've been on for over a year. Energy, make money as both investing in fossil fuel, as we've seen with oil, and in clean energy, as we've seen with carbon. That's one of the pair trades that we have.
Right.
We have big positions in both XLE. As you know, I focus mainly on ETFs. Big positions in XLE, big positions in KRBN. Both of them are working, and they can work together. So there are really significant opportunities because in the midst of all this, we're having to deal with climate change and climate mitigation.
Right.
And that, to me, is the single biggest global macro trend theme of the decade.
And John, what's so important in this narrative, and frankly what we heard from Ben Laidler, David Kostin, or John Golub, is the response of corporate leadership to the cards they've been dealt.
And that's going to be the difficult thing for the quarters ahead, Jay. The cards they've been dealt with so far are higher costs, a struggle to access the goods they need to sell. We're going to see a lot of that through Q4, through Q3 earnings season. Jay, what's the playbook for you? And I know that's a shorter time horizon. I just wonder how you look to approach it.
Yeah, we're going to look through it, John, because I think, again, markets focus forward. And if anything, if we've learned anything over the last year, that speed is picking up. I called it COVID speed a year ago. I introduced the concept of climate speed a month ago. Speed is really the thing to focus on. So you have to look forward. I think the markets are going to pay much less attention, investors much less attention to Q3 results, much more attention to Q4 in 2022 outlook. And yes, supply chain issues are a concern, but they are going to fade. Asia is reopening. The port backlogs are going to ease. All that stuff is temporary. It's not permanent. And so as it fades, that just provides a tailwind to the upside. Profit margins are at all-time highs. I'm a believer that we have a chance to move into a higher than above trend growth outlook, which is fueled by a CapEx boom, which I've written about, just about perfect conditions for a CapEx boom, which can provide a productivity surge, which offsets the increase in wage costs. And we have an environment like the second half of the 90s, from 95 to 99, when you had productivity gains offset wage gains. So you had a high growth, low inflation environment. Stocks did extremely well. I think that's what we're setting up for in the developed economies around the world in the next couple of years.
Just to confirm